Welcome, welcome to SDSU Extension Ag Economics Dialogues. Today we're going to look at crop input costs and interest rate outlook, some cash flow items, and then probably working capital. My name is Jack Davis. I'm the Crops Business Management Field Specialist out of the Mitchell office. So anytime that you have a question today, we want to make it pretty open as we call it academic dialogue. So put those in on the chat and we will stop and get those taken care of. And of course, we can also do them at the end. But anytime you have a question, make sure and get it in that chat and we'll surely address those the best we can. As I said, I'm Jack Davis, the Crops Business Management Field Specialist out of Mitchell. And first off, we're going to take a look at a budget comparison on crops. So we're going back to 18, 19, and also then look at 20. And I'm going to minimize some stuff so I can see my full slide here as we're going through. And these are the crop budgets that were compared, not necessarily actuals. And so I think some things we'll kind of just take a look at corn to start with. That'll be the easiest. And we can see that 18 out of these 3 years was probably our lowest revenue. So we were looking at about 570 or so in corn. And these are in our crop budget model or spreadsheet. These are for East Central South Dakota. So kind of a higher production, looking at about 180 to 200 on corn yield for bushels, and anywhere from like 320 to 350 for price of corn. So you can see gross coming out about 570, and then projected for 2020 of 700. Now, there's some big what ifs there as we ran into this year and the ability to get the crop planted. And that is probably stressing cash flow this year and to a certain degree the working capital. Direct costs were pretty even in 19, maybe up just a little bit, but we do see those falling for 2020. And we'll take a closer look at a few line items there as we go forward. So a little better return over direct costs projected for next year. Equipment probably running about the same, but we also want to look as we're looking into cash flow. Are we at a point where we need to start replacing some things, and are they in good repair, or can we gain some efficiencies, and do we have the capital to gain those by updating some machinery? And then the bottom line in these budgets shows a return to land. So if rents are running that 180 to 200, their yields had to be better or price had to be better to cover those costs. We just didn't have it in the last couple of years, again, putting stress on working capital and probably cash flows. Now, projected going forward into 2020, and assuming everything and weather kind of gets straightened out, we look to possibly get a little better, at least on the corn and soybean side. And for 2020 is the 200 bushel corn yield. So of course, talking the higher production of eastern South Dakota and somewhat into the central on good grounds and properties. And looking at 200 yield, and at the time when I put these together, you could contract right around 350 for next year's corn. So a gross of 700, and it kind of works and gets a return to some labor and to the equipment. So you can just see at that bottom line kind of where it covers return to land. Rents could possibly be covered better on a corn soybean type crop situation. Okay, taking a past look at corn input cost. And this material is taken from FinBin using South Dakota, North Dakota, Nebraska, and Minnesota farms on crop farms. And I'm narrowing this down to corn input costs just because there's the most information that's available there. And we're looking at some of the top 5 expense items. A couple of them fixed, and couple kind of fixed and variable. So these are averages for those time periods. We've got a 5-year average in the first two columns there, 2007 to 12. And they got the top 20% as far as net profit, and then the mid 20% as far as their profit goes. And that's how those are sorted. So if we're looking at that first column, we end up with a gross revenue of 926 and a yield of 182. So from that period, you know, we're starting to and of course they inflated, as we can see, from that 5-year average to our next 2013 to 15, a 3-year average. Seed went up from 85 to 112, and fertilizer also went up at that point, you know, from 112 to 140 or so, 140, 150. And land rents out of this group that were participating in this record keeping program, they also went up by about $50 an acre. Machinery costs also went with that. Of course, a lot of people replaced machinery during that time frame and were able to update in a good way and gain some efficiencies also. Of course, if you're grossing more, they tend to take more out for the management fee and for living, a natural progression. So gross during that time was starting to come down in our region, or in this region of the 4 states. So rather than the 926 on the top, we're at 807. And part of that was yield. Yields didn't as average as well during that time frame, but also then there was price pressure. So now looking to 16 through 18 in actual cost, and we dropped again. And of course, our input costs did not drop as much as our revenues to generate gross. So we really started to have that squeeze on cash flow and working capital. Yield had gone up a little for that time frame. It helped some of those top producers stay profitable. But if you weren't able to gain those yields, it really put the squeeze on your cash flow. Transition to the next slide here. And can you move me forward, Heather? There we are. So still looking at the same thing. This time I took all crop farms and went back another year, 16, 17, 18. And then, so that's all the farms, no matter of size, and then showed it for a 1,500 acre crop farm, and also then for a 2,000 to 5,000 acre crop farm. Again, kind of sticking with the corn, just because there's the best data available for the corn. So when we went back on these, yield was right at 192 in 16, 194 and 176 in 18. As you see, same progression down a little bit. And gross revenue staying right in that $600 level the last 3 years, 650. Maybe if you were lucky and got a really good yield, did a good job on marketing, you might push that up to 700. So looking at a $600 gross per acre on corn. And of course, the squeeze was still there on the input cost. And again, kind of for the larger size, just showing their cost, may be able to get a little bit of a discount on seed as we move to a larger farms, and also a little bit maybe on fertilizer. And we can see that their land rents tended to be right about the same, maybe a little bit higher for the largest size farm that we have in this group. Management fee about the same, Machinery costs maybe a little bit higher than our mid group or the average there. So again, just going to focus on last year's and kind of see where they fell out. We'll take a closer look at this. Between what in this FinBin project, you can sort it by quintile. So take the top 20%. So that would be the very top end of as far as net profit. Skip the next quintile and move down to the one below that. So we got one group separated here between this top and mid. And you can see gross sales of about $37 difference. That's what's off to the side there. But where they really were able to make it up is in their direct cost. So between that top and mid level, there was close to $100 difference in direct cost. Overhead was only about $9 difference, but the total on those was $142. So quite a bit of difference just between that top and mid level. And then of course, if you throw all the in, it stresses it down a little bit more and a little tighter cash flow when we consider all farms together. It's broke down into just some of those line items, big savings probably on rent and seed, fertilizer running pretty close to the same. Rent, seed, and machinery costs making up the biggest difference between that top 20% of profit and the mid 20% of profit. So here at these top 5 expenses and then some target area, probably that higher end being or a good target to shoot for in looking forward. And fertilizer on a high profit, that should say 18 versus 17 there at the top. But fertilizer at about 14% on the high profit, seed right around the same, and land 25% of gross, machinery running about 14, 15, and labor 6 to 7% of gross. So using those targets that are set up in the middle, I'd like to see fertilizer right around 14 to 15% of gross. And of course, depending on your area in South Dakota, you can calculate what your gross might be, say using 325 to probably 350 price on corn going forward in 2020, and then yield accordingly. So I got a range of 450 to 700, and those could be used as some guidelines to see where you fit in for price and how it might work in cash flow coming forward into 2020. Yeah, and of course this year with weather just really set us up poor for much of South Dakota. But again, this is we're looking at if we get it planted and decent growing conditions, or what we might call average growing conditions going forward. We're looking probably a drop in fertilizer coming up in 2020 compared to 19. The other thing, producers have probably fertilizer on hand that they weren't able to use. If they had prepaid, that's probably still in a prepay. Most co-ops or vendors won't take that back. They pay a little more storage on it. The producer does and holds that fertilizer over for the next year. So there could be some fertilizer that's on hand or in prepays coming up this year that was actually paid last year or last fall. So that'll be something to watch and producers to watch to know the fertility. That's one of your higher cost items. So, and after this year, it'd be a really good idea to put some extra management effort into that fertilizer side in doing some testing, see where you're at, see what the ground needs, and go from there. Seed, finally seeing a reduction in seed price, and probably a lot of that is because of the nationwide prevent plant. Maybe that inventory is up a little bit and they're wanting to move some of that seed. Again, guys will want to get the best seed for their ground. It's not really a place to cut your expenses, but manage it closely and do a good job of getting the right seed for your area. But as I'm talking putting the budgets together for 2020 and talking to suppliers, anywhere from probably a 3 to 7% lower seed costs this year. We're talking corn, and also then beans will be down too for seed. And machinery varies quite a bit by operation. A lot of that's just more of a fixed cost, a depreciation type situation, and we may be running out of that as we haven't replaced, maybe as we're in these tighter budget times or cash flows. But then we'll also want to look at, are they at a point where it needs to be and repair costs are running too high? So that's really an individual operation, and they'll want to take a close look at how repair costs are comparing with depreciation or maybe some replacement. Take into account leasing machinery there. I'll be careful with that, and just make sure we're accounting for all our machinery costs and getting it put in the right place to help us manage. Now, Dr. Matt Dearson will come forward and we will talk, or he will talk a little on interest rates.
All right, good morning, everybody. I'm Matt Dearson. I'm the Extension Risk and Business Management Specialist, and I'm also a professor here in the Ness School of Management and Economics at SDSU. We're taking a look at the interest rate situation from a couple of perspectives. We'll just look at changes in interest rates, and magically my slides are going to appear. Just going to get the slides figured out. Just a second as we get this figured out. There we go. Back on track. A challenge with financial data, we really are kind of hamstrung because we've got a couple different sources of data. At the national level, you really only get a good breakdown with about a 2-year lag. So the best national data we have of detail is 2017 data, and there's interest rate data that's fairly current. Then state level data tends to be restricted, where we only have 2018 data. So presents a little bit of a challenge. So some of the references and things will be to what may seem like out of date data, but it's the most current that is available. If we take a look at interest expense, this actually goes back to the 2017 census, and this is just for big picture comparison. We have all farms and ranches reporting interest expense in 2017 of $12.4 billion, and that's only 3.8% of all expenses. So interest expense itself is not huge as a major cost factor. And then if we look at the breakdown for the 2 million farms in the United States, only a third had an interest expense in 2017. So the rest of the farms, you may have retired farms or even hobby farms where they're not doing much of any borrowing at all, and then not having an interest expense. So for perspective, it's there, and the interest expense would be indicative of how much leverage a farm has. The higher the leverage, the more interest expense they're likely to have. And just the presence of interest expense is an indication of different kinds of debt use. If we zoom in a little bit and look at the South Dakota data, we've got data here from the South Dakota Center for Farm and Ranch Management. We can see that farms, for the most part, have high asset values. So the average farm in South Dakota, the data set there was about $3.5 million of farm assets, but cash makes up a very small part of that asset base. So you can see the average cash here. This is not unusual to have under $25,000 on average of cash here. So cash is not making up a huge portion of working capital. That working capital, current assets minus current liabilities. More of the current assets are based on things like grain available to sell. The other thing to note here, we've got the interest expense ratio for this sample of farms at 5.6%. You can see that these farms borrow a lot of money during the year, primarily operating capital. So the average farm in the sample borrowed about $520,000 during 2018, giving that interest expense slightly higher than you'd see when we looked at the aggregate, which didn't include, or which included a lot of farmers who didn't do any borrowing at all. You also see we've got a low return on equity and return on assets for 2018. I'd like to transition to a slightly different data source. In the aggregate US, farm income this year is expected to be a little bit higher. 2018 in South Dakota was the highest farm income level in over a 5-year span. But we've got some data here from the Federal Reserve Bank out of Minneapolis, or the 9th District Federal Reserve District. The data comes from the Ag Finance Data Book. And what we've got here is just a snapshot during the second quarter of 2019. 62% of banks, ag banks, were saying that they expected farm income to be lower than a year earlier, and only 8% had farm income expected to be higher than a year earlier. This snapshot point in time, so this would have been back in April or May, just gives some idea. That's the data behind a bigger set of data. We can look at a diffusion index of that farm income over about the last 2 decades. And it would take this raw data, so the percent saying farm income, for example, was higher, less the percent saying farm income was lower. Adding 100 to that gives us a base of an index of 100, or if you want to think about it as 100%. What that index looks like over time, I've got 2 of them shown here on this chart. One is the that same farm income we just saw for the most recent second quarter. If we look at that over time, that's kind of that dull color there, going back all the way to 2001. You can see farm income based on the diffusion index. Anytime that's higher than 100, farm incomes have been up compared to a year earlier. Anytime it's below 100, farm incomes have been down compared to a year earlier. You can see that from about 2013 on through the current time period, we've had consistently steady lower levels of farm income reported by these ag banks for their customers, and that trend has just continued. Every time it starts a little bit of an uptick, like we had in 17 and even 18 there, we can see it quickly gets under stress again. Now, overlaid on top of that, we also show the farm household spending. It's not quite as variable, not quite the swings up and down that you see in farm income, and that hasn't gone down across the board as much as the farm income level has. So farms are using other sources of income or dipping into savings to keep some of the farm household spending stable, even in the face of farm income variability. Got another set of data related to this. Instead of looking at farm income, we look at capital spending. This would be spending by farms reported by banks again. So banks saying our customers are having a lower level of spending on capital purchases. Biggest one here is probably machinery. So capital outlays where there's borrowed funds involved. We see for the second quarter, 64% of ag banks in the 9th District were reporting lower capital spending and only 5% higher capital spending than a year ago. That's okay, but I think the longer run trend is really what's more of interest here. We've got that same farm income diffusion index. So looking for higher income and higher spending when it's above 100 and lower income and lower spending when it's below 100, we can see that both of these data series, farm income and capital spending, move very closely with one another. What had been fairly cyclical, a good year, a bad year, moving along, you'd have a chance for higher farm income to contribute to capital spending, replacing some machinery, for example. But what's really happened since 2012, 2013, as farm incomes have stayed down, capital spending has stayed down. Now, what my point with this would be that if we take a look at the duration of this, even a durable good like a very solid tractor or other piece of machinery, it is going to start to wear out, wear down, become obsolete over time. Classical economic example of a durable good eventually wearing out. And there was a fair amount of investment in new machinery when incomes were high, those capital spending levels were high. We've also seen this go along for enough years now that we could be starting to see a time period where some of those assets will sort of have to be replaced, or they're just not going to be usable to maintain the productivity level needed. So that suggests that we might be under some extreme pressure in the next couple of years. Probably the one thing that's available to sort of give a little bit more in addition to the input costs, the direct input costs that Jack mentioned, would probably be land rents. Land rents would probably be under pressure if across the board farmers need the cash and the capital for capital improvements rather than the variable input costs. I'm going to shift gears here too. Another sort of interesting source of data, this also comes from the Ag Finance Data Book, would be ag interest rates. If we take a look at ag interest rates for the from the Federal Reserve, get this advanced here. Here we've got ag interest rates. This is 20 years of agricultural interest rates. So interest rates paid in the 9th Federal Reserve District by farmers on new loans. So a new operating loan for a given quarter or a new fixed land loan, where land is the collateral behind this loan. Two major classes of farm related loans. And what we've got here is about 20 years of interest rate data. So a couple things stand out. If we look back at 2004 to 2009, all interest rates moved from just below 7% up to around 9%. So as the Federal Reserve restricted or tried to cool off the economy by increasing interest rates, farm level interest rates increased as well during that time period. Since then, we've had a long period of low and stable, steady interest rates until the very recent period where, again, the Federal Reserve is trying to cool off the economy a little bit by raising short-term interest rates, and that carries over to all interest rates on the cost of funding side of things, and those are passed on to farmers. For example, here we see that interest rates have gone up. We've got another chart showing a similar type of distribution of rates. Actually, while we're still here on the land rates, we can just see that those tend to be a little bit less than the operating loan interest rates, reflecting the higher risk of an operating loan, collateral and such, compared to land loans. Here we've got a chart that also shows that same operating loan on a fixed basis compared to operating loans with variable interest rates. So we're in a period where we're thinking that interest rates may go lower. Well, a variable rate loan would be preferable to a fixed rate loan, depending on the time frame you're looking at. Over time, those tend to be close to one another. During down periods or lowering of interest rates, the interest rate on the variable rate interest rates tend to be lower than fixed interest rates. With the at the national level for the third quarter, a little bit of a mixed signals coming out of what's happened with interest rates. The Fed has continued to lower short-term interest rates. The interest rate on nationally for livestock loans was down a little bit compared to the second quarter, but the interest rates on machinery loans were higher at the national level. And again, nationally, we've got a very wide range right now of farm level interest rates, new loans to farmers ranging anywhere from 3 to 8% nationally. And one last thing on this, if we take a look at the very extreme end out there. Nope, I'm going to save that point. So I'm going to shift gears, moving away from the Federal Reserve to a totally different data set. We do have interest information. This data comes from the Farm Credit Funding Corporation. A little bit about this data. This would be the data that the Farm Credit System would pay to institutional investors for bonds and notes that they are offering. So this is the interest rates that the Farm Credit System pays to investors. Once the Farm Credit receives funds for those bonds, for example, those funds are converted into notes, which are lent to, or notes are passed to ag credit associations such as Farm Credit Services of America, and to ag banks such as CoBank, which then passes on and makes loans to farmers or cooperatives. So this is the system's cost of funds. This is publicly available data, and it just gives a monthly snapshot of the costs and bond equivalents over the last, it's available weekly, but this is a monthly aggregation here. And I just chose a few points in time. 2006 shown here. This was the August of 2006 was the point in time where we had the highest recent interest rate levels, both short-term and long-term. Then we look at 2013, that's when short-term interest rates, or the cost of funding the Farm Credit System, would have been at its lowest absolute level over the last, I think, 15 years is all that's in this data set. And then 2016, we had the lowest recent long-run interest rates. So that sort of shows the span of costs of obtaining funds over time for the Farm Credit System. Now, that's interesting in and of itself, and we can see that farmers, for example, with cash holdings would have seen their short-term interest rates at deposit institutions. So on a savings account or a money market or checking account would have been relatively high back in 2006, and then the returns on those cash holdings went to near zero in the last several years, and it's finally started to increase a little bit. So what's happened since 2016? Let's look at the most recent time period. Here's the last year or so. So we've got a few different things showing up here. We've got 3 different months that I picked out, just showing when interest rates were low, when they moved around a little bit. Let's focus on the left-hand side of this for just a bit. The very short-term interest rate level. As the Federal Reserve changes interest rates, the change happens pretty much immediately for the Farm Credit System as well on the short-term financing cost. So if we look at October of 2018, interest rates in the short run were just above 2%. The Fed increased short-term interest rates that pushed interest rates up to about 2.25% there. You can see in April, and since then the Federal Reserve has lowered interest rates, and that's brought interest rates down to where they were at the end of September, for example, at below 2% on the short run. Over on the other side, you can see the long-term interest rates, the cost of funding. So the cost of the Farm Credit System to issue a 30-year bond in September was down below 3%. And in August, it was even a little bit lower than that. So we are seeing long-term interest rates at the lowest level in quite some time. I can't speak of records because farm credits go back so long through this source, but an implication for the farm sector is, for example, with the farm credits costs coming down, that's given them and all lending institutions seeing their costs of funds go down in this type of setting, that could be translated into lower interest rates passed on to borrowers. The other thing that happens here is if we see, come at this from an investor perspective, with the returns available on long duration instruments. So 30-year bonds, for example, if the return on 30-year bonds falls from, in this case, 4% down to 3%, that's going to have the opposite effect on land values. It should be positive news, supportive of land values, because the interest opportunity cost of other investments has come down substantially from a year ago at this in this market or in this setting. Now, how does a producer take some of this information, or what are the other decisions that farmers would be looking at this time of year tied to financing? I think the other main thing that's happening this time of year is looking at a cash flow budget or a cash flow projection for 2020. I teach our ag finance class on campus, and in that class, we do lay out a projected income statement and a projected balance sheet for a fictional farm. But when we do that, we also lay out a projected cash for the farm operation. I take that cash flow, and then we include some seed, some fertilizer costs, whatever, and then we also include some debt payments and things. We work through a quarterly projected cash flow for the operation. So at the farm level, I encourage, and I think Jack does this too, encourage producers to think through what might be included in that cash flow budget. This last year, or 2018, has been a challenging year for producers, as some of their normal income streams from flooded crops and whatnot have been, we've also had different kinds of inflows from insurance payments, and it's also been challenging maintaining capital levels for several years. So we have heard different stories over the last few years of different types of debt restructuring to sort of correct cash flow problems that farmers have had. So with all that, it's hard for us in the dialogue here to sit down and say, well, let's visit with every farmer and figure out what their specific cash flow needs might be. That's maybe beyond the scope of what we're trying to do in the dialogue. But we did want to boil it down to some of its basic ingredients. And that's where one tool I use that sort of takes some of the detail out. It doesn't eliminate the detail, but it says, let's step back and look at this from the really big picture perspective. With that, I like to use the projected cash flow, and I like to use really what's in some of the older textbooks. Let's develop a sources and uses of funds statement, which is just take a sheet of paper, take a cocktail napkin, take the back of an envelope, and write down, here's the different sources and uses of funds that the farm is going to experience over the next 12 months. So for the calendar year 2020, it's going to include things like crop and livestock sales, other farm income, maybe some income from a portion of the farmland rented somewhere else. On the uses side, surely those cash operating expenses will be rather large, but there also might be things like full and interest or the debt service payments available, or that will need to be done. The operator needs family living withdrawals to keep them out working the land, and then sort of the inevitable taxes. If we focus in on a couple of these at a time, Jack talked about the likely changes in budgeted crop costs. So if we think about the crop enterprises, likely next year, if it's a more normal year, a little bit hard to fathom what that is in South Dakota these days, but if we have a more normal year, what would normal crop sales be for the operation? Those need to be balanced on the use side of funds for what changes are we seeing or expecting with cash operating expenses. So that would be one aspect to incorporate in a projected cash flow. Another couple of major sources and uses. Focus on the use side first. If there is machinery that really needs to be replaced, either because repair costs are getting so high or the machinery itself is becoming obsolete relative to your needs, if machinery is needed, that's going to require either a down payment or full purchase amount, perhaps even a lease. All those capital purchases are going to require some cash during the calendar year. So that would be another reason to lay out how many dollars are going to be necessary for those from the use side. And then on the source side, credit reserves. It's not typical to include credit reserves as a hard source of funds, but I wanted to put that in there as something to think about, in part because we have heard different farms having to refinance or restructure some debt using credit reserves that way, taking some perhaps some operating loans that have you weren't able to repay this year. Well, that's gonna, if you restructure that, that's going to mean increased principal and interest payments from fixed loans, for example, for the coming year. So that might be, that would be a negative ramification, but still nothing you want to ignore looking at. And then just needing capital purchases and whatnot, if there's room in the financial situation to draw down or use some of those credit reserves, that's why you kept them there. If it has worked out, if you have kept those reserves in place, you can draw on those or use those, that borrowing capacity, if you would, to meet some of the use obligations you're expecting for the coming year. That's all I had for prepared remarks related to the interest rate situation. There is a Federal Reserve meeting where they'll at least be discussing, who knows for sure if they will change interest rates, but it'll be another step in the process. And the fact that interest rates have come down relative to where they were lessens the interest expense. We've also seen that we've got stress or strain on as far as a continued reduction in farm capital purchases and outlays. This could lead to a problem going forward in the aggregate of replacing that machinery or having the funds available to replace that machinery. That's going to have to come from somewhere, probably pressuring land rents. At the same time, the lower long-term interest rates have kept land values supported. So quite a few things going on. Big picture, or from the big picture perspective, relative to interest rates, and then at the farm level, it's really a case-by-case basis, but there has been a lot of stress on the working capital situation, and the sources and uses of funds framework might help discern problem areas moving forward. At this time, I'll call, are there any questions that people want to ask at this time? If not, we'll transition to Jack Davis again. Checking with Heather. Okay, we're going to transition back to Jack here.
Okay, we're ready. If we can pull the slide up. Heather, do I do that or you got that? Come, there it is. Okay, yeah, as Matt, we talked about this last week, and there is that downward pressure from an operating standpoint to put on land rents, but the interest rate drop or lowering, or at least not increasing, has really helped to kind of hold those land values pretty steady, especially on land that's in good farming conditions. So we've kind of seen those land values hold pretty steady, which is of course good for for borrowing and good for the future, hopefully. So we're going to break down working capital and just its definition and some different measurements on that. So as Matt explained just a little bit, current assets minus current liabilities. And let's take a look first at current assets. We, that is the things that are going to be turned into cash. And as Matt pointed out, there is not much cash really held on many farms. So it's in inventories. So how are those inventories held, and are they kept in good condition? Are they at risk for a price drop or at the benefit of a price increase? So those are things that individuals and lenders have to work through and see where the protection is, see how it's stored, make sure those things are in good condition. That could be a challenge in this year's harvest environment and the growing conditions we've had. The guys will want to really stay up on top of that and work through that. Of course, current liabilities, the thing that comes in there is those accounts payable that are due and notes payable. Sometimes as things that maybe get left out of there is if we've refinanced and we now have the current portion of principal due, maybe an accrued interest. So those are things when people are looking at maybe stretching things out for a little bit. And what is that really going to do to your working capital? It may buy some time, but also then you got to add in those principal and interest payments that are coming due within the next year or accrued interest. So some different ways that it's measured, expressed as a single dollar amount. Of course, it's valuable for the individual farm to track that over time and just see where that is at, maybe compared to his sales too. Another one I like is a dollar amount per acre. So if we're using crops, that would be a way to look at that. I need this many dollars per farming acre to have in working capital. And another popular one is a percent of gross sales. I will look at that going forward here in some charts, and that's one I really like to use. So we're taking that working capital measurement, current assets minus current liabilities, and then dividing by gross sales and expressing it as a percent of gross sales. Another one that's become popular recently is as a percent of total expenses. So using the cash flow budget or projected budget, or just even actual expenses, where does that working capital fall as a percent of those total expenses? And we're transition. I jumped to, we got both of us. Okay. So this is using that same data set. So took it from a broad perspective of national and looking at that data set of crop farms from North Dakota, South Dakota, Minnesota, and Nebraska. And so we're kind of a select data group here. So it'll be those that are participating in the Farm Management Association or a record-keeping program that submits their data to FinBin, which is housed at University of Minnesota. And again, picked on 1,500 to 2,000 acre crop farm and 2,000 to 5,000 acre crop farm. And we'd really, like to kind of see this above 30% and maybe even a little stronger when we're under stress or making a change, either growing or adding to the operation, or even if we're moving into retirement. So if we're transitioning, we probably want to see it a little stronger than that 30%. And we can see here that it has fallen the past few years, and probably fallen a little more for the larger farms, which would probably be an indication of those having to maybe rent more and paying the higher rent to acquire those acres, and putting more stress than when there wasn't a profit in the last few years of crop production. This, so probably it depends on where they're at, what they were able to plant. We could see some more stress on this again this year, just due to that prevent plant and amount of dollars that people have coming in. And yeah, as Matt had mentioned, it's really hard to get a broad sense of that because of the wide prevent plant. And what yields, final yields will be, and price of crops. This is was from ERS. I think that's not showing up there, but just showing the farm sector assets, and this is inflation adjusted for 2019 dollars. So we see a increase in asset values, which has really helped keep our debt to asset ratio really in pretty good position nationwide, or on the aggregate, as Matt had said. And we'll see also that most of our asset value is in real estate or farmland, and also in the lower interest rates. So that's good. It's helping hold that balance sheet in a strong position. What producers and individuals have to worry is keeping that cash flow and liquidity in place as we manage through these years of challenging weather and downturn in price. Same type of graph, just showing the debt level, again, adjusted to 2019 dollars, and just showing that about 62% of the debt is real estate debt on a national level. Taken from the same source, debt to asset ratio, right at 13.5 in projected for 2019. So still a very strong position. I think if we could, you look back to when it was under real stress, it was above that 15 on a debt to asset, and clear up into the 21-22% debt to asset ratio. Now, narrowing it down to that more local group, again, a little bit biased because it's those that are participating in this record keeping area. In total, it ends up being about 2,500 farms total. So just kind of a small sample of our region. And we can see that the 1,500 to 2,000 acre farms, 16 have a pretty straight line of increasing that debt to asset ratio. So just have had to continue to borrow to keep things going forward. And a little flatter for our larger farms, but then have taken a bump up in 2018. And we'll see how that fares through 19, between, again, what they got planted, some of the support payments and disaster payments that'll come through. Switched a little bit. I do not have the definition of this term debt coverage ratio, but really it is, are we able to cover all our obligations and have some cash left over? So taking all the operating expenses, paying off the term debt, principal, interest, plus a withdrawal, and it's really, how many times can we do that in a year with the sales that we have? So this is, for our smaller group, is probably fairly strong. It's above 2 and even above 2.5. For the larger group, it is really tight. You start dropping that below 2, and this is hung right around 1.5 times. Things got to work pretty good to not fall even or below and have some carryover debt. We're going to, again, ask for questions. You know, the economic dialogues work best when there is dialogue, but I can understand if you don't have questions, you sure reach out to us at any time over any of this material that we presented, or if you have other questions and want issues addressed, be sure to contact us. I'm going to leave you with this set of points to think about, and the top one is probably the most important. In knowing your numbers. Understand what an operational change makes to your balance sheet and financial situations, and know your financial numbers, compare them to a data set, either your own data set or an industry data set. Take the time to do that. Matt mentioned working through the cash flow. That's going to be the challenging part, has been the challenging part, will continue to be the challenging part, but it's very important to work through that. And I like to see, guys, that I know we can't touch on it, but get to the detail, use that as your operating plan throughout the year. Take your actuals, as Matt mentioned, even quarterly, take your actuals quarterly compared to what you had budgeted. Add on the next quarter out a year or so and see if there's changes that you need to make or where you're at. Just keep and use that as it's supposed to be used. Use it really as your operating plan, help you control that cash flow. Price risk protection, you know, there were opportunities maybe to sell ahead this year. It was really, really difficult from a individual standpoint because of the planting conditions. People that are able to get on top of that and manage that price risk are usually the ones that are ending up on the top profit. I'm from an area that we're probably farming, or much of the land is farmed, that is highly erodible. So I'm a big proponent of conservation practices and the use of those principles. There are some programs available that help, if you're not used to doing that, that can help you get a little subsidy or payment for trying some things on your farm and see how that works out. We're still commodity business, so you really have to work hard on getting the most out of each dollar that is spent, and really concentrate on those top 5 items of whatever they are for your farm. Try and lower those the best you can without giving up much in the way of yield or total product sales. So you really got to watch that. You don't want to just go in and cut costs to blanket cut. Be strategic on lowering those costs and where you might fit in. That comes back to knowing your numbers, not just your financial numbers, but also your production numbers. And as we talked earlier with this year, soil sampling is probably a very good way to spend some money and get a management plan on where you're going to spend your budgeted fertilizer dollars for 2020. Rents, highly individual. Of course, from a production standpoint, on most farms, it is open to probably try and get a reduction there. Capital purchases, again, we're kind of like, as Matt had said, machinery is not going to last forever. Again, be strategic on going through that. And then, of course, non-farm cash flows, manage your time in a very good way. That's what I have, and we'll leave you with that for today, unless we have some questions that came in. There is available, this Matt had used financial measures from South Dakota Farms. There's a publication out there, and this is the website where that is available. And then also, if individuals want to prepare their own trends, there is a spreadsheet available also at this link. So those would be things, a couple tools that people could use. Also coming out on our SDSU extension website will be the projected crop budgets for 2020. So people can start to use that to plan for next year's growing year.
So if we do have any questions coming in, if you would please type them into the chat box, we will get them answered for you. And make sure that we get all of your questions addressed. You can either write them in individually to everybody, or you can send them as a personal question to the Heather file or the Matt Dearson person there. Otherwise, you have the contact information for Matt and Jack in their presentations, or send an email to the heather.gessner email that came with your registration, and we will get your questions to you there. So we'll give you a couple more seconds if you're in the process of typing something to send us a message. Otherwise, we will say thank you for joining us again today, and we will try to do it again next week. Not next week, next month. Okay, seeing no further questions, we're going to stop the meeting for today. So thank you very much, and we will see you next month.